So the three pillars are manage, protect, and then the fun phase is the growth phase. I think it's important that people have control of their money and their retirement. I created a plan for my money so that I knew where it was going.
But what was it that put you on that path to success?
That strategy, we're aiming to generate 4% per month in cash. And over a 5 to 7 year period, the strategy will add a zero to your investment.
Hi everybody, this is Boris Schlossberg. Welcome to yet another episode of The Trading Battle. Today I have a very, very special guest with us, Andrew Woodward, who is on his way to disrupting wealth management on his task, up to 1 million people by creating his own 3-pillar framework for how people can actually grow, compound, and create wealth in terms of investing. So welcome to the show, Andrew. So great to see you. It is a very noble goal of yours. Many people, especially in a very uncertain economic environment where it seems like every 6 months the world changes in a heartbeat, both geopolitically and economically and technologically, that people are, I think, constantly looking for solutions to how to really grow their long-term wealth. So we'll talk a lot about that. And everything else, but welcome to the show.
Thanks for having me, Boris. And I think you're being a little bit generous with saying things are changing every 6 months. It feels like it's changing every 6 minutes at the moment.
Absolutely. I mean, it's not unrealistic to think that most jobs in 2 years from now could be replaced by AI, or at least changed radically by AI and everything else that's going on. It's not unrealistic to think that we could have lots of geopolitical tension that could have resource implications. You never know. It is a kind of a crazy world. And also, I think the other interesting thing is just from a demographic point of view. I think most people just are completely unaware of how, although they're starting to become aware of this, how in the advanced industrialized world, the demography is just so toxic to people's wealth going forward. What I mean by that is, if you're in any way, shape, or form are depending on some sort of a government pension or some sort of a government check to take care of you into your old age, let me disabuse you very quickly of that idea. It's not that the governments don't want to do this. They will absolutely be unable to do this in the next 10 years. I think you would agree with me on that, right?
Totally agree. And, it's a significant component of why, my goal is 1 million people, because of that exact fact.
Right. I mean, it's just, we're in an industrialized world. We basically have a one-child birth rate. We are living 30, 40 years more than we were supposed to, according to actuarial tables. And, I think there was an economist named Herb Stein who was a advisor to President Nixon, of all things. And he used to always say that if something is unsustainable, it cannot be sustained. And, eventually the system will simply break, just because the liabilities are far, far greater than government assets at this point. We can't have, 2 young people supporting 10 old people for the rest of their lives and expect any kind of equity out of that. So yes, I think, people really have to take their own prosperity and their own retirement very much in their own hands. Would you agree?
Well, that is the basis of my business, The Investor's Way. It's about people taking personal control for their financial future, because of everything you've just said, but also just generally because, I think it's important that people have control of their money and their retirement and the lifestyle they want to have, and they design it themselves rather than rely on somebody else or a government to do it for them.
Yeah, absolutely. Do you find that, people always say that most people think more about their next vacation than they do about their retirement planning? Do you find that true with a lot of clients that you've come across?
Totally. And a lot of the people that I work with, especially those that have the ability to generate a reasonable income, whether they're business owners or employees, but those that tend to have access to more cash, one of the things that they speak to me about is making sure I don't curtail their ability to have holidays. And
that they're more concerned about that than
yeah,
actually being able to be financially secure. That's interesting.
that's right. It's like, just do not restrict my ability to have holidays. I'll work with you and I'll do all these things, but I must still be able to have my holidays. And you're right. People spend more time thinking about the very near term rather than the long term. And unfortunately, that's why we've got some of the statistics that we have, particularly in our country, in Australia. But I'm sure those statistics apply around the globe.
No, I think it's a general rule across all of OECD, uh, for all the reasons we talked about: demography, people's habits, lack of, you know, the other. I mean, there's sort of these positive and negative things that are creating the perfect storm. The positive things is that we're all living longer. We're all much healthier for a whole bunch of reasons. Medicine has gotten much better. We're able to diagnose things much better. People stop smoking. That's really good, but it's also really bad because we're still sort of living in a world where people retire at 65 but live till 95, and you have like 30 years. People used to die at 65. I mean, excuse me, retire at 65, die at 70. Great, that was a perfect actuarial table. To be, not to be macabre about it, but if they have 30 years of income stream, it's, that's like a third of your life that I think few people are prepared for it unless you're a multimillionaire and you just simply can fund everything.
It's a long time retired, and one of the things that I always say to my clients is nobody has solved the equation of when you will die yet. And so when it comes to planning, you have to think, what if I'm around for 30 more years after retirement, or even more? Like how will I survive that journey? And yeah, you're right. Like, the actuarial calculations are just not keeping up with the fact that people are living a lot longer.
Technology has totally blown it out. I'm actually curious, do you find a lot of your clients, especially business owners, now no longer think of 65 as a retirement age? They now sort of maybe think about 70. Like they tend to work. I mean, I'm just thinking, my own dad, who's in his late 80s, he's certainly retired, but he's still running his business like on a ghost level. My sister runs it, but he still has a business and he still has a business income. Yeah, if he didn't have that, they'd be in serious trouble.
I think with business owners, entrepreneurs have a different mindset and makeup to your employees, and when it comes to working, and the majority of the business owners that I talk to always say to me, there's no way I will stop working at the age of 65. That I will be doing something well beyond that. They all say that. Whereas those people who are in a job where they're just getting a paycheck, they're like, I want to retire before I'm 65. And, it's a very different mindset. And, I often say to people, well, what's going to keep you occupied in those years? Like, it's all well and good to have, a retired goal and an income goal, but what are you going to do to keep yourself occupied?
Well, before we get into sort of your ideas of how people can protect themselves going forward, let's talk a little bit about your early days, because you obviously you got into the financial markets, you traded, you sort of been around the block. You told me you've traded almost every single asset around the world. So I'm just curious, what sparked your interest in finance? How did you get involved, and what was your initial experiences with all of that?
Yeah, so I could make this a really long story, so I'll leave a few little bits out. But I played squash against men when I was 14.
Did you hustle money?
I wish I was a hustler at that stage. I could have made some money, but I was in a team for one season. So there was 2 seasons a year, and one of the seasons I was in a team of 5 people total, and 3 of them worked in the financial markets. And they spent 6 months. They spent 6 months getting in my ear about you've got to get your money working for you. So they kind of like planted this seed for 6 months in my head about get your money working for you, get your money working for you. And I was fortunate that numbers was my thing at school. So I gamed the schooling system because I was good at maths. And so I was able to do reasonably well at school, go to university, get a job, get married, have a couple of kids. And all the way through that time, I had an interest in this getting my money to work for me.
So, what kind of a job were you doing when you come out of school and you were, your early married years?
Yeah, look, if as providing you don't tell anybody, I was an auditor. Yes. And so I qualified as a chartered accountant, was working as an auditor, and I always had this interest in the markets. And I knew that it was a way to get your money to grow without you having to do a whole lot of effort, that passive income side of things. And I'm quite happy to admit that in my early years, I didn't practice what I now preach. And I did all the things that you shouldn't do. Spent more than I earned. Took big gambles or big risks
Your investing ideas.
in my investing. Early on, and then
What are the wild, some of the wild harebrained schemes that you tried that you took a
none of them were necessarily like left field, but I got into trading options pretty early on. And I was writing call options and put options and just getting myself at times getting beyond my capacity and rolling positions forward rather than just taking the loss and then ending up with a bigger loss. And
Sorry, were you writing naked options or were you writing covered options?
predominantly covered calls. But at times, they were in lost positions. I'm rolling them forward and getting myself in a spot of bother. And so I just did everything wrong initially.
But if you were covered, you still had the underlying. So
Yeah, but I was writing covered calls for income.
the underlying was going against you, and you just wouldn't get rid of the underlying, and that's how you lost money.
Yeah, I'd roll it forward and so forth. And so, I was just doing, some silly things until I finally woke up to myself and turned it all around.
So that's a common story. But then did you also trade CFDs on Forex and gold?
Yeah, so I got some training on how to do all of those markets and traded. My favourite markets were gold, which I think, I don't know why I became in love with gold because I think it's one of the hardest
Because
markets.
you're Australian, that's why you became a little gold. I think it's part of the nationality. If you have that citizenship, you naturally it's like an ethnic trait.
Yes.
Trade gold.
Yeah, so gold, and the US dollar against the euro, they were two of the more favoured markets that I had to play in. But I gave it all a shot. Leveraged CFDs, all that type of stuff.
When you were trading like that, was it sort of like, I'll take a trade, let it ride for a couple of days, or were you like literally on your phone checking quotes every 5 minutes? How was it?
Yeah, so when I was a trader, I was a full-on trader. So I was staying up at night and trading the London Open into the US Open, and I was looking to get in and out in the day generally. But there were times where I let positions go and actually went to bed and just let the position run. But quite often I was in and out in the day. And watching the screen, going a little bit goggle-eyed because of watching candles go up and down all the time. Can do your head in. But I did all of it. I did it all. Lost 5-figure sums on trades at times, and I've done it.
So you've learned from the school of hard knocks.
Absolutely. As I said, I've made all the mistakes, and when I talk to my clients, I say I've made all the mistakes so that you don't have to.
Right. No, absolutely. So what was sort of like a transformative moment that kind of brought you to understanding, okay, this is not the way I want to do things. I want to do things different. And then what was the result of that effort?
Yeah, so I came home from a long day working for somebody else, and greeted the family at home. So I had 2 young kids and my wife, and she handed me a parcel of mail one night when I got home, and I thought I was pretty popular on this day because I got lots of mail back in the days when you got physical pieces of mail. And I started opening up all this mail and discovered that most of them were bills. And I started doing the mental math and going, hang on a minute, these are starting to add up to more than what I'm earning. It was that moment where suddenly I started sweating, my heart rate was going up, and I'm thinking, how the hell am I going to tell my wife that we've spent more than I can earn this month, and we're in a spot of bother here. And so that was kind of like the aha moment that I had to start doing something differently. And I just devoted myself to turning it all around and finding the information out there to help me. and doing all the the training and changing the habits so that I got on top of all of that so that I could move forward rather than go backwards. And it's all about keeping up with the Joneses at that time. Young family, everybody around you spending money left, right, and centre, and so I was doing the same thing. But yeah, I had to change. I knew it. Yeah, you couldn't continue down that path, and slowly but surely we got on top of it. And within 10 years, we'd made our first $1 million net worth, and we've just never looked back since then.
That was a transformative moment. But what was it that you actually physically started doing that put you on that path to success?
Yeah, so I don't believe in budgets because I think they're like diets. They're great on paper, but useless when you need them.
Yeah, I agree.
Yeah, so I found a way, a process that's evolved over time. But basically, I created a plan for my money so that I knew where it was going. I made sure money was set aside for all the essentials, and then we just lived on what was available. So instead of just doing whatever we want, whenever we wanted, we had to live within a certain perimeter or means. And that just enabled me to get on top of the debt. And then once the debt was sorted, get on top of growing our wealth. And the funny thing about all of this, and I say this to my clients all the time, once you're on top of your money and you're actually growing it, it doesn't feel like there's any restriction, and it actually becomes a lot more fun. And there's nothing worse than juggling credit cards and debt, moving money from one like robbing Peter to pay Paul type of scenario.
It is the equivalent. I consider it's the equivalent to crack cocaine. It's the exact same thing as a drug addiction because you're always behind, always behind. You're always looking for that miracle lottery ticket that's going to get you ahead. I mean, anybody who's ever been in debt and then has managed to crawl themselves out of it, if that's been a transformative experience, they've never gone into debt again. I'm sure you've never used right. I know in America they actually have a term. The credit card companies have a term for people like me. They call them deadbeats. Anybody who settles their bill essentially in cash at the end of the month, they hate them. They hate me because I never carry any credit card debt, which is really the stupidest debt in the world to carry. But the industry term, it's actually the industry term is deadbeats because we're only profitable for the transaction cost, not for the.
Yeah, that's right. Yeah, the banks want you in as much debt as possible because that's how they make money out of you, and the whole system is designed that way, which again is why I do what I do.
So kind of like just to put this into concrete terms, imagine you have a $10,000 income, and you say to yourself at that time, I'm just giving us a hypothetical example. Our rent, our utilities, our food is, kids' clothes and whatever school supplies. It's like $5,000 a month. Those are fixed costs. Like we have $5,000 worth of essential costs that are non-negotiable. And then we're left with like $5,000, and then we have to, whatever we want to do with that, we can choose to do. We can choose to do that. Is that how you sort of segregated your money? Was that the mental math that you did with your family?
Yeah, and with that 5,000, and obviously in my scenario, it was a lot closer to the 10 initially. But with that money, I split that between bills, so things that were essential or regular, and then there was the living type expenses. So this was food, entertainment, activities, and all that type of stuff. And I separated those so that money was set aside to cover the bills. It was always that money was always there.
Right. So that was like inviolable because those were not variable. Those were fixed expenses.
Money had to be set aside. So some of those bills might have been quarterly or annual. So every month some money got set aside for those so that when those bills came in, there was cash set aside and it was just paid for. And then there was the living expenses. Like I said, the groceries, the entertainment, eating out, all that type of stuff. And we just lived with whatever was available. So, and what we did there, and this is the system I now teach, is that was a weekly amount. So no matter how often I got paid, and I was one of those unfortunate ones in those years where I was getting paid monthly. So I would transfer to an account weekly an amount of money so that it felt like we just had to get through a week at a time, a week at a time.
So you had to two separate accounts. You would segregate.
Yeah. Yeah. And so if we drained that account, we just have to wait until it was topped up the next week before we had access to more money. Now, yeah, that meant at worst, if we ran out of money, we might have a day or two where we might run out of money initially until you get into the habit, and it just, you get to make that money survive the full week. And that transforms the whole thing, because one of the traps or bad sides of monthly pay is when you get to those 5-week months. And if you don't have some form of system to control your money, those 5-week months will kill you from a spending perspective. So by topping up that account on a weekly basis, we did two things. It meant we only had to get through a week, and we tricked our mindset into thinking we were getting paid more regularly than we were. And that meant we were starting to build up a better money mindset at the same time.
Interesting. It's funny because it's the same kind of technique I use, and I know a lot of people use as far as trading. When you're trading highly leveraged instruments, you're always going to go on tilt, meaning that you're always going to just completely lose your mind. And if you have 100,000 in your account, you'll spend 100,000, whatever. I mean, we've all done that 1,000 times. But if you take, let's say, that same 100,000, let's make it 10,000. You take that 10,000 and you subdivide it into 3 accounts, and you're just trading one account, and you blow that account. The two things that happens. First of all, however much money in the account that you have, the broker will take all of it, because you're going to keep increasing size of the instrument until you blow the whole account. So if you just have 3, you'll just lose that piece of capital, but you still have 2 other pieces of capital that you can trade down the road. And it's sort of a very similar idea. You don't touch any of the other accounts until this one is blown. By actually doing that, you learn how to preserve the small account, and then you start trading better. And so basically, instead of constantly refilling one account endlessly with your capital, you actually learn how to maybe refill a tenth of that account every few times, and then you get better at it, and then you get to be able to grow your trading accounts.
Yeah, exactly. Yeah,
similar idea. It's really interesting. Yeah, it is amazing how simple it is to fool ourselves into this, and how efficient it is. Like, the mind just really adapts to the parameters you set for it. Like if you create constraints for it, you will survive within those constraints, and you'll actually thrive, because you'll start to become creative how to thrive within those constraints.
Yeah, it's no different to people who get pay rises and then are no better off, a few months later with that extra cash because of lifestyle inflation. So they earn more, so they spend more. If you don't have that discipline or a structure around your money, then you'll just find a way to let it slip through your fingers. And your example is exactly the same.
Yeah, no, that's very, very true. So your system is called the 3-pillar, or it's called the Wealth Generator Program, right? That's the name of your program. And then within it, there's sort of a 3-pillar structure. Could you give us an idea of what does your program do? How do you coach your clients, into creating a long-term lifestyle changes and investment change?
Yeah, so the 3 pillars are manage, protect, and grow. So I often use the analogy of building a house. The first thing that we want is the foundations in the ground. And if those foundations are not sturdy, if we're going to put a house on top of it, eventually that house is going to fall over. So money and wealth creation are no different. If your foundations are not sturdy, you're just not going to get the results from your investing activity that you want to get. They just won't be optimized. So the managed pillar is all about creating a solid foundation around your money and introducing an automated money management system, so that, like we were talking about before, we identify a monthly surplus of cash over and above our living and our bills costs. And that surplus is then automatically put into investing activity, whatever that might be. And by doing that, we overcome the limitation of budgets, which is, and I'm sure listeners will have experienced the budget phenomenon, where they say, I'm going to save $1,000 a month, and they get to the end of the month and there's no $1,000 available. So my system takes that money out at the start. But I call it the pay yourself first money, and that goes into investing activity. So the manage pillar is about creating that foundation of success with your money. So almost to try and guarantee success with money. And then the protect pillar is about creating like a shield around your financial circumstances, so that if anything goes wrong, you've got mechanisms in place to provide protections, whether that's an illness or an accident, loss of a job, any of those types of things. We build those protective mechanisms in place, and we teach how to manage risk and how to have an understanding of risk and return. And then the fun phase is the growth phase, which is about putting your surplus, your monthly surplus, putting that into an investing program or plan and strategy that gets you to what I call your financial freedom number, which is where your assets are funding your lifestyle. And putting that into a plan and helping people, teaching people how to do all the relevant investing activity that will get that result, and empowering them with the confidence, the tools, the resources to be able to do it themselves, so they're not relying on somebody else who doesn't care about their money as much as they do.
That sounds really great. What is the formula for making assets pay for your lifestyle? Like what is the mix of investment ideas that you generally recommend people to get to that state?
So I'm unique in that I don't have a bias to one or the other. In this country, in Australia, there's a massive bias towards property. And there's good reason for that, because our property market doubles every 9 to 10 years. So there's a lot of people in this country who've made wealth just for.
I always find that very ironic about Australia, a place of like 2 people and 10 million square miles, but yet property market just, I remember when I flew into Sydney, you fly into the Sydney airport, and all you see is like literally, 15, 20 miles of empty land. And yet everybody wants to live literally on George Street. And property just like nobody even thinks that, oh, maybe we could just live 45 minutes away and property will be cheaper. It's just it is. I always find it very fascinating. It's not like you don't have any land. It's just that you all want to live in a tiny little space of it.
90% or more of our population lives on the coast, whether it's the east or west. But so we have a love affair with property, and so there's a lot of companies out there that will teach how to grow your wealth through property. I'm of the belief that you want to have diversification, a very misunderstood term, but you want to have a spread of assets that have different risk profiles, return profiles, and liquidity. And so I actually teach people stock investing, property investing, gold, silver, and bonds, and it's some other, for my higher net worth individuals, we look at some other boutique type of investments. But it's about having a spread and accumulating assets for as long as you possibly can, so that you achieve that number.
What are the instruments that you recommend? So I want to invest part money in stocks, part money in gold, part money in property. And I was actually going to ask you, do you at all look at crypto as an asset? Is that something that you recommend?
So with crypto, I just haven't got myself comfortable with the risk profile. I understand that it's likely to be something that's around forever, but I just can't get myself comfortable with the risk profile at the moment. And so I don't teach it. It doesn't mean that I tell people not to invest in it, but certainly if they are going to, it'll be a smaller portion of their portfolio, just purely because of the risk profile. I don't think anyone really truly understands the risk profile. So it's out there. I know at some time it's probably going to become more mainstream, but right now I don't think it is, and it's difficult. So I do teach everything but that, effectively. So it is stocks, property, and those defensive assets like gold, silver, and bonds.
In North America, most financial advisors simply whatever instrument they want to, whatever asset they want to expose their customers to, they simply put them into an ETF, because there's literally an ETF that is either the virtual variant of the physical asset, or a simple passive strategy into that particular asset. Is that something that you do, or do you provide different ideas for the instruments?
I like to think I'm a little bit different to that because, whilst I'm not completely anti-financial advisors, I do call myself the anti-financial advisor. And the reason that they put them into ETFs is because they can earn a fee from them.
Yes, that's true.
And so with my teaching, I'm about what's the most appropriate asset for my client because I don't touch their money. So I definitely teach ETFs as a part of my stock investing program. And even if people can't afford a physical property investment, we look at ETF property related investments.
Like REITs and stuff like that. Yeah.
Yeah, that's right. But they're only a small component of what I teach or what I expect people to have in their portfolio. But yeah, ETFs are a great thing, particularly for new investors who are a little bit scared of the stock market. It's a great way to introduce them to it without them taking a huge risk.
It's also, I guess, in America, the view is most people don't have the skills, the attention span, or the desire to actively manage a specific asset. So they outsource all of that via an ETF, who's going to do the rebalancing and the averaging stuff. Now, within that kind of mix of stuff, um, how do you balance income producing assets against capital gains assets? Like, what do you think is the proper mix?
Again, I guess I'm slightly unique in I don't follow a strict formula of it has to be X% to be a portfolio. It all comes down for me to the timeline that people are working towards. So if I'm working with a 45-year-old versus a 30-year-old, their timeline is different, which means their risk appetite can be different, their mix can be different because they've got more time. So it all comes down to what's going to deliver the outcome they need in order to get to where they want to be with a risk profile that they're comfortable with so that they can sleep at night. So it just is very individualized based on all of those factors. And so I hate that. I hate hearing people say, "Oh, I was told I should have 10% in this and 20% in that and 40% in that." There's just no right answer in terms of percentages. Has worked, or has historically worked for everybody. So it's a very personal mix of what people are comfortable with, but at the same time, what return will get them where they want to be.
Right. And that's also very, dynamic. It's impossible to anticipate how that makes it work going forward. So you have. So do you review the portfolio once a year? Do you rebalance with them? How does it work in terms of the management part of it?
So from a management perspective, we're looking at obviously long-term goals again. And, I touch base with my clients after they've finished my program, which is about, by the time they've been through, it's about 18 months that we're together before they're kind of completely on their own as such. But in that time frame, we're checking on them, a few times throughout the year, particularly if, something significant in the markets is happening that would warrant a review of, their position. But generally speaking, it's all about a long-term goal, and short-term market volatility or movements, we just ride them out. But again, I'm teaching people to recognize when it might be time to adjust.
What would be like a couple of scenarios where it'd be wise for a person to adjust?
I think if we saw something like the COVID stock market, where we saw a massive, rapid drop in the market. For me, what I was explaining to people at that point was everyone was panicking. I often make the joke that if you'd turned the financial news on during COVID, and it wasn't a joke, but if you did turn the financial news on, you would have thought that stock markets would have ceased to exist because of the amount of panic and fear that they were talking about. And what I was trying to explain to people was it was always going to be a short-term thing. But nobody knew it was going to be, in terms of the length of COVID, what that was going to be. But if you look at the stock market, it recovered rapidly, far more rapidly than anyone would have expected. And I was looking at that as an opportunity rather than a fear or panic moment. So, what I was saying to people was, if you had cash available at that time, it's a great opportunity to maybe not necessarily rebalance your stock portfolio, but certainly load up and take advantage of the massive discount that was available in the market. Well, and so it's more about just recognizing what's going on in the individual asset class and making decisions about, is it opportunity or is it time to just sit back and let the market do its thing. And even right now, we're probably in a moment of opportunity. We might not be at the bottom of the opportunity, but we're certainly we've come off all-time highs in the stock market, and so there's history that suggests we're going to eventually create a new all-time high above the previous one. And so we're in a period of opportunity.
I day trade essentially for a living all day long, but whenever I get boxed in at cocktail parties and people always ask me financial advice, I always tell them there's only one thing you need to do, which is dollar cost average into an index fund, because unless the laws of capitalism get flipped over, and at that point it really won't matter, stocks have what's called an upward drift. Basically, if you believe that the economy continues to grow because of technological progress and innovation by human beings, that growth inherently is embedded in an index of stocks. The index is going to go up and down. It's going to have sometimes years, maybe even occasionally a decade of non-performance. But if you're constantly averaging into that position, your dollar cost average breaks you even way sooner. I mean, a classic example, there's 1,000 examples in history, but like a classic most recent example is if you dollar cost average into the Nikkei, I think you were break even by 1997, maybe 1998, and it actually physically never didn't take off its highs until now, right? So think about it, a person who just buys it at the top and never adds to the position, and a person who buys gradually, how much more capital they would have had in their wealth. And that's true of virtually almost every major index. Do you agree with that?
Absolutely. One of my favorite teaching moments is to look at the S&P 500 over the last 18 years. And I say 18 because that's the maximum chart that I can on my show. And I explain to people that even if you're investing today, where we were up until recently at all-time highs, if you assume that it was 18 years ago that you're investing and you follow that 18-year trajectory, you're going to 5 or 6 times your investment just on the one you make today. But if you, like you said, dollar cost average, the returns just compound and become phenomenally well. And I often get asked, what's my favorite stock investment I ever made? And it's the S&P 500 index ETF, because I bought it in Aussie dollar terms. I bought it at about $9 something. It's trading at 60 odd. And I've bought it many times along the way.
And it's compounded. I mean, and that's true. That's true also for for high quality individual stocks as well. If you just you always hear the stories of this lady was a legal secretary, or she was a maid somewhere, but she took $50 every month and she put it into this one stock, and she died 10 million richer and gave away all her money to charity. So you hear those stories in America all the time, but they're true. They're really true. That is the right behavior. For very few people actually do that, but it really doesn't. People with modest means can achieve $1 million portfolios by the time they're dead. It shows that almost anybody can do it, as long as they have that mindset of pretty continuous allocation of capital to the market.
And the problem with that is that, like you said, there's plenty of people who have done that. We just don't hear about them.
Right. Exactly.
Yeah.
Exactly.
And as a result of not hearing about them, people don't think it's possible, because all they hear about are the billionaires who discovered something like, I don't know, Facebook, and then before you know it, they're a billionaire because it's gone off the charts. But there's many more examples of people who just with modest means been able to convert that into large sums of money.
Have you come across a few of those amongst your clients where this person has just really been surprised? This person is sort of earning a very modest income, and then their asset base is just far greater than what you think it would be.
Yeah, well, one of my favorite stories is a client who came to me, and he had a net asset position of about 17 million when he came to me.
Wow.
And one of the things he said to me was, I've got all these assets. I have no idea how I got them. or how to convert them into an income stream that will provide me the lifestyle I want. Please help. And
You must have said, "This is the easiest job in the world."
yeah, that's right. And I mean, it sounds funny for someone to say to you, I don't know how I got them. But clearly, he was doing some investing, but he was just farming money out to other people to do the investing for him. And the reason he wasn't getting the results from it was basically he was paying someone $3,000 a month to manage his stock portfolio that at the time was about $8 million. And he had, when I looked at it, he had over 60 individual stocks in his portfolio. And the unfortunate thing was about 20 of them were just variables of the same thing. But to justify the $3,000 a month fee, this person felt that they had to keep buying new things, which was really just the same thing.
Same thing, different flavor. Yeah.
That's it. And so we did a lot of consolidation
So
and
you cleaned up his portfolio, you straightened it out, and I'm sure you probably put a lot of it into income generating product that basically paid, as you said, let the assets pay for your lifestyle, which is the ultimate goal of anybody, anybody anywhere. I mean, that's to put it impolitely in America, that's your FU money. That's when you can achieve that status. It's also it's not. I think people really misunderstand. Money is not greed. Money is actually personal power, because that is how we settle things in modern capitalist societies. And it's not about you just grubbing for money. It's you actually achieving a absolute sense of agency, which is really what all human beings want. They want personal agency, meaning that you are not beholden to anyone, on anybody's schedule, and absolutely forced to do things that you don't want to do if you have the assets to be able to control your life. It's ultimately the ultimate freedom, actually.
yeah, and like an early part of my program is dealing with that whole money mindset scenario. And some people think, oh, you're going to go get woo woo on me, but ultimately, to put a different tint on what you basically just said, is that it's not the money that we want. We want the choice and the life experiences. And in order to have those, we've got to have the money to be able to fund them. And so when we transition from chasing money to trying to achieve those choices and life experiences, and we kind of lean into being the person that is going to have those things in their life, we're far more likely to get them, because the attention's moved away from the money to what we're actually trying to get. And when people understand that, the money flows so much more easily, because the focus is not on chasing money. Like, if you try and chase a rabbit, you'll never catch it. But if you have a plan and a structure around what you're trying to do, you'll get what you want. And it's very much about what's going on between the ears to start with.
Exactly. So, not putting you on the spot, and fully disclosing that yes, everything it's different for everybody. A lot of a typical viewer of ours would be like somebody who's a 45-year-old person, and they have 30, 40 years of working life ahead of them. What would be the basic generic financial investment plan that would pretty much set a good foundation for them? What would you recommend as a kind of composition of investment ideas?
Yeah, so look, a 45-year-old is right in the middle of my core client base. So 90% of my clients are 40 to 55 years old, and that's generally because they've woken up one morning and gone, that retirement thing is a whole lot closer than I thought it was. I'm going to start doing something about it. And so the first thing we do is look at, well, what do you have as your starting point? And like I was saying earlier, in this country, the majority of people are going to have their principal place of residence. They're going to have their retirement account, or super as we call it here, and not a lot else, generally speaking. And so the first step is to understand how much of the equity in their home they're prepared to use to help them grow their wealth at a more accelerated rate. Understand how much they have on a monthly basis for investing purposes, and then start accumulating a property portfolio, a stock portfolio made up of 3 different strategies, And then, down the track, we'll look at the defensive assets. But initially, we want to get into, above average capital growth, income producing assets that may not necessarily be at their prime income production initially, but we've got that plan. So over that 20-year period, it's in a position, where it will fund your lifestyle.
So what do you mean by sort of like the asset may not necessarily be an income producing asset now, but could be 20 years from now? Like what would be an example of that?
So, again, thinking of Australian property, generally at the moment with interest rates the way they are, property investments are negatively geared initially. So, it's costing us each month to fund that property. But over time, as the property goes up, the rent goes up, your mortgage comes down, and that balance changes. And so that you're now got a cash flow positive property in retirement that will then go towards funding your lifestyle.
So is this something where you're purchasing a property and then you're renting it out? Is that what you mean by like?
In Australia, there's a sad statistic that property investors buy one property and less than 20% of them will buy a second or a third. And so I'm trying to teach people strategies that enables them to get that second and third one. And most of the time they get stuck because of the way they structure their finance. And so we help them structure their finance so that they're more likely to be able to buy a second or a third property. They're still able to grow their stock portfolio. They're contributing to their retirement account and putting themselves in a position where they've got a mix of assets that in retirement will provide that outcome that they're looking for.
Right. Because 20 years forward, like you said, two things will happen. Their mortgage costs will go way down. The property, even if it stays at the same level, let's just assume the worst case scenario stays at the same level, it doesn't compound at all. Just the spread between the low cost mortgage and the rental income will be a positive spread.
And that's like at the extreme end of unlikelihood.
Right. I always look at the dark side of the street.
Yeah, that's fair enough. But in this country, a property will have doubled at least, once, if not twice, in that time frame.
Is that been the history of property in Australia? That is sort of like, what is the doubling of value in terms of duration? Is it every decade and a half?
Historically, it's been every 9 to 10 years. If you're buying
doubling every 10 years,
yeah,
that is pretty good. As Larry David says, pretty good.
I love when people say to me, like, they'll look at a property in their location right now and what it's costing. And, it's right now we're in this environment where everyone thinks like property prices can't go any higher. Like they're already extreme. And I'll say to them, look, just go and look 20 years back and have a look at what that property was worth 20 years ago.
Well, take a look at like the magazine articles 20 years ago, because, I live in New York. Yeah. And it's sort of like, I remember, I'm old enough to remember like in the 90s, people go, oh, stock, it is so expensive. It's never going to go up, and it's basically a fraction of that. It was a fraction of it then versus what it is now.
Yeah, maybe they won't continue to double at that rate, but they're going to go up in value. And like you said, the gap between the value and the mortgage, it grows. And the cost of the finance reduces, the rent goes up with the property value, and so you've got an income producing asset in retirement.
Super interesting. And then when it comes to stocks, you said there's sort of like 3 ways that you guys structure stocks.
So with stocks, I teach obviously ETFs, individual stocks, and then I teach a strategy that incorporates stocks and options.
Like sort of a yield strategy where you're writing calls against safe stocks, or
so it actually starts with selling a naked put.
Yeah. Oh, are you doing the wheel? Are you doing the wheel? You sell the put, you buy the call, you buy the underlying, you sell the call, and you just kind of continuously do this. And you do this obviously on very, very well established.
That's right.
Typically, ideally, you want to do this on dividend-based stocks, because then you compound your yield as well.
Unfortunately, with and this strategy I teach is only for the US market. I tried to do it in the Australian market, but our market is so small, the premiums on the options don't make sense.
Right.
So we do it on the US market.
What are some stocks on the US market where that strategy has worked well for you? Like, I know, for example, one of my friends used to do this on Occidental Petroleum.
Yep. So I run them through 8 criteria to, Warren Buffett style criteria to determine whether or not they're a stock that we will do the strategy for. Then I use a research company's 3 to 5 year forecast, and they must have a 3 to 5 year forecast that has the share price at least 20% or more higher than where it is today. They're the two gates that they've got to pass before they become a stock that I'll consider doing the strategy on. And then we look at timing, the sale of the put to enter the strategy. And then once we get exercised, we own the underlying. And then once that stock rises in value above what we got exercised on that stock at, we start selling calls against it. And so, like there's a lot of stocks like that this strategy works for, but one at the moment that's doing quite well is Nike.
So we actually reported numbers today that were a little bit better than expected, so it should be just perfect for that.
As I said, there's many stocks that are doing well. And one that hasn't done so well for me is Walgreens.
It's a nightmare. I would just dump that baby. But I mean, I think these are strategies that really work well on mega caps as well. I mean, obviously, as long as the mega cap is not super expensive, because they're just so liquid. I mean, you could do this on Apple like probably all day long, right?
Yeah, you could.
Yeah,
yep.
And it would work fine. That's very interesting. Now, that type of strategy, is that do you get double-digit returns when that's working for a year?
Yeah, that strategy, and I can already hear people listening to this who are about to say, "Yeah, bullshit, that's not possible." But that strategy, we're aiming to generate 4% per month in cash, which enables us to then buy more stock. And over a 5 to 7 year period, the strategy will add a zero to your investment.
So what you do is interesting. So obviously, it's always an income generating strategy. That excess income that you generate off the calls and the dividends and whatever else is coming and capital gains, you just basically siphon off all of that and invest that into something else, right?
No, we leave it in the strategy to compound.
Oh, you just leave it in the strategy to compound. Okay. So basically, you do a little bit bigger size as
that's it.
Very nice.
You want to be in that strategy. Like any money that you put into that strategy, you need to have the mentality of, I'm going to leave it there for 5 to 7 years to get that uplift and that compounding effect. But when you look at a retirement plan, you don't have to invest a large sum of money so that in 5 to 7 years it's compounded dramatically, and then alongside all your other assets, it becomes an income producing part of your portfolio that you could pull out if you wanted to.
So just to put that in sort of concrete terms, you can start out with 100 shares of Apple, and after 2 years of success, that'll now be 150 shares of Apple, and then 4 years forward, you might be doing 200 shares of Apple. So now you've literally doubled your income streams off of the same capital base.
Yeah, that's right. Using other people's money effectively.
Right, effectively. All the yields. So you're turning volatility into yield. Yes. That's very, very interesting. It's really good. Now, one asset that has actually beaten the S&P, I bet most people don't notice, since the year 2000. You probably do. What is that asset that's beaten the S&P since the year 2000?
That'd be gold.
That would be gold. So my question to you is, what do you think is the forward forecast on gold? Are you bullish?
Well, yeah, look, it's really, I find this really, really fascinating because traditionally gold is a defensive asset that, we utilize when the market is defined as risk on. So when the stock market is, falling, or the property market is falling, money's pouring out of stocks and into gold. But if you look, like you just said, since the year 2000, gold has outperformed the index. And even if you narrow that focus even more, we've just had all-time highs in the stock market, all-time highs in gold, and property markets growing in value. It just didn't make any sense whatsoever. So it's very hard at the moment, from my perspective anyway, to know exactly what gold's going to do, because we are potentially, with all the the geopolitical stuff that's going on, we're potentially moving into a risk-on environment where gold is going to take off, and it has in the last week.
We fresh highs above 3,000, and trading really well, holding the 3,000 level. I mean, I've been scalping all day long.
Just this week, it's gone from 3,000 to 3,040. So we're in that environment where I would, I'm saying to clients, we really want to be in gold in this type of environment, and you want to be in it before it moves, because gold moves very quickly.
I'll give you one macro idea for why I think gold. I'm super bullish gold, and the simple idea is any country where the service of the interest, just the interest on the debt, starts to exceed the deficit, gold becomes just a default. They have to then turn to gold to revalue all of their because once your debt service becomes greater than the amount of money you're able to take in from tax revenue, you're just in trouble. You have to revalue to gold. So
yeah,
that's, and we're getting close to those levels in a lot of OECD countries, and the actual what's happening now, especially if you take a look at Germany, where they're going to do massive spends because they have to increase their defense budget. It puts everybody on that hamster wheel of trying to finance it out. So that's why I think gold is actually seeing such a strong bid underneath.
Yeah, and I guess from my point of view, it's been encouraging people to have the confidence that even at these levels, it was the right time to get into gold. And for those that have been able to do it, it's been quite profitable in the short term. What it means medium term would be I'm fascinated by it to see where it goes. But like you said, we're moving into an environment where the gold position will be very, very powerful. And the other one that excites me as well is the fact that silver and gold in traditional ratios are way out of whack. You're completely out of that traditional ratio in terms of their prices. So either gold's got to come down or silver's got to have a massive run. And based on what we're seeing, it's more likely that silver's going to have a run than gold that's going to fall.
It could be it's a lever play. And then the other lever play that I discuss all the time with everybody here in America is gold miners, the really big ones, the Anglo Americas, because gold miners always lag the metal because they're hedged and because it takes a long time. But then once, let's say, we reach 3,000-4,000 on the underlying, their profit margins just explode, and stocks begin to really, really perform well too.
Yeah, yep.
So there's a lot of exciting ideas there going forward into 2025. Andrew, it's been wonderful talking to you. Is there a place where investors could reach you, and what is the best way to get a hold of you?
Happy for people to reach out, and we offer a no obligation free initial chat to people just to understand where they're at, what they're looking for, and if we think we can help, we'll talk about how we can do that. So you can go to the website at theinvestorsway.com.au, and if you scroll to the bottom of the homepage, there's a couple of free resources at the bottom. In particular, my favorite one is my wealth tracker, which is a workbook. It's an online workbook that you can use every month to track your net worth across all the asset classes. And the longer you use it, the more often you update that with monthly data. There's some algorithms in the dashboard that will show you the trajectory you're on. And that becomes a way we're gamifying our mindset and tapping into that part of our brain that says, I like what you're doing, keep doing it. And so that's at the bottom of the homepage. It's called the Wealth Tracker. It's a free resource, and it's my favorite.
Well, it's been really eye-opening. Generally we talk to traders who hold for 5 seconds, so it's really nice to step back sometimes and discuss the more serious aspects of investing. And it's been really, really fascinating to have you aboard. Thank you so much. You've really opened up my eyes to quite a lot of interesting tricks of the trade that all of us could use to kind of grow.
Pleasure to share, and thanks for having me on.
Great. Thanks a lot, guys. And thank you again for visiting us at the Trading Battle. Please be sure to subscribe so we can bring you more episodes. And as always, I will see you guys in the markets. Boris Fonsberg for the Trading Battle. Over now.